Is a $600,000 home expensive? Well, in places like Boston, San Francisco, or Miami, that price tag can feel surprisingly normal. But the real question isn't just about the sticker price it's about what that mortgage actually does to your finances over the long haul. Let's break it down. A $600,000 home is definitely well above the national average, but in many high cost of living areas, this is becoming the new normal, especially if you're looking for a larger home for a growing family. Before we get lost in dreaming about granite countertops and walk-in closets, it's as crucial to understand what a mortgage of this size truly means for your bank account, not just today, but for the next 15, 20, or even 30 years. Your monthly mortgage payment isn't just a simple calculation based on the home's price. Think of it like a recipe. Each ingredient changes the final flavor of your financial future. This is the foundation of your entire home purchase. The more money you can put down up front, the less you have to borrow. A larger down payment, say 20% or more, does a few amazing things, which often translates into a more favorable interest rate for you. Plus, a 20% down payment helps you avoid private mortgage insurance, or PMI. Getting rid of that fee is like giving yourself a raise. This spreads your payments out over a very long period. On the other hand, a shorter term, like a 15-year mortgage, comes with a much higher monthly payment. It's a bigger bite out of your budget each month, for sure, but the upside is huge. You pay off your home twice as fast and save an incredible amount of money on interest. For a $600,000 loan, the difference in total interest paid between a 15-year and a 30-year term can easily be over $100,000. The choice between a 15 and 30-year term really depends on your financial discipline and your monthly cash flow. Now, let's discuss what is arguably the most influential factor, the interest rate. A higher rate means higher monthly costs and a much higher total amount paid back to the lender. A lower rate reduces that long-term financial strain, but on a $600,000 loan over 30 years, it can add up to tens of thousands of dollars in extra interest payments. Your credit score plays a huge role here. A higher score tells lenders you're a reliable borrower, and they'll reward you with a lower rate. So, before you even start house hunting, it's a great idea to check your credit report and do everything you can to improve your score. Then there's the type of mortgage loan you choose. The two main players are fixed rate and adjustable mortgages. A fixed-rate mortgage is all about stability. Your principal and interest payment stays exactly the same for the entire life of the loan. Whether it's year 1 or year 29, you know exactly what to expect. This makes budgeting predictable and provides peace of mind. They often start with a lower introductory interest rate for a set period, maybe 5 or 7 years. This can make the initial monthly payments very attractive. If rates go up, your payment could increase significantly, introducing a lot of uncertainty into your long-term financial plan. An ARM might make sense if you plan to sell the home before the rate adjusts, but for most long-term homeowners, the stability of a fixed-rate loan is the safer bet. We also can't forget about location. Location. This doesn't just affect the home's price, it also has a huge impact on your ongoing costs. Property taxes and homeowners insurance can vary wildly from one city or state to another. In some high-taxed areas, these two costs alone can add hundreds or even over $1,000 to your monthly housing payment. Most lenders require you to pay these through an escrow account, where they collect a portion of the annual cost each month along with your mortgage payment. This means your total monthly pity, that's principal, interest, taxes, and insurance can be much higher than you initially calculated. It is essential to research the property tax rates and average homeowners insurance costs in the specific areas you're reconsidering before you fall in love with a house. And finally, let's touch on a big expense that often catches first-time buyers by surprise: closing costs. These are the fees you pay to finalize the mortgage and transfer ownership of the property. Closing costs typically range from 2 to 5% of the loan amount. For a $600,000 mortgage, you're looking at anywhere from $12,000 to $30,000. These costs cover a whole range of services, like lender fees, appraisal fees, title insurance, attorney fees, and more. You can either pay these out of pocket, or in some cases, you can roll them into the loan. While rolling them in might seem easier up front, remember that you'll be paying interest on that extra amount for the entire loan term, making your purchase even more expensive in the long run. So, when you bring all of these factors together, the down payment, the loan term, the interest rate, the loan type, your locations, taxes, and insurance, and the closing costs, the true cost of a $600,000 mortgage becomes much clearer. The initial home price is just the starting point of the conversation. What really matters is how all these different pieces of the puzzle fit with your personal financial goals. The big takeaway here is simple: being an informed buyer is non-negotiable. Understanding how loan structure, interest rates, and long-term planning work together is the key to making a smart decision. It helps you avoid nasty surprises down the road and ensures that your beautiful new home supports your financial stability rather than becoming a source of stress. In today's complex housing market, knowledge isn't just power, it's your best tool for building a secure and happy future. Thanks so much for watching. If you found this breakdown helpful, be sure to hit that like button and subscribe for more deep dives into real estate and personal finance. See you in the next video.